Welcome to another episode of Loan with Jen, real facts, no BS, everything about mortgage. So today we have a super special guest. She's a financial wizard, Karina Gutierrez. And Karina, welcome.
Thank you, Jen, for the invitation. I'm excited to be in your program.
Yes, Karina, I have known her for many, many years, dates back to our college days. I was an exchange student in Monterrey, Mexico, and I can tell you from experience, she does not leave a stone unturned. This girl was a hammer when we lived together in Mexico, and we've been friends, God, almost 30 years now. So we're dating ourselves. Karina, you are with Xfinia Financial Services, so you're going to have great knowledge for us today. I brought you on because I really wanted listeners to hear about why not to put 20% down. And you and I talked offline about that. So are you ready to go?
Yeah, sure.
So tell us first just about your kind of general knowledge base about just kind of what you do, just build some credibility so people know that you know what you're talking about.
Oh, yeah. Well, I'm a CPA in Mexico, and I specialize in international finance, but most of my career has been in financial services here in the US. I've been here in Houston over 25 years. So I've been living here longer than I live in Mexico. So we have always helped clients that wanted to invest here in the US. We don't only help domestic clients, we also help foreign nationals that want to move their money to the US and invest here.
Yeah, that's great. So your knowledge base is super broad. Lots of analysis that you're doing with markets all over. So mortgages, my point today that I really wanted to make is mortgage rates really have always been, as far as I've been doing this 27 years now, they've always been lower interest rate than what people can earn in the market. Is that pretty much your 25-year experience tell you as well?
Yes. When we are doing a financial analysis, we always analyze debt. And mortgage is always the good debt that we don't want to pay off early.
Right.
We want to keep it, paying it, of course, on time to keep our perfect record, but not prepay it, because usually interest rates here in the US are very affordable, very low, sometimes incredibly low, and makes no sense to prepay the house, since that money that you have, you can invest it in the market or somewhere else, even in some other real estate investments, and make money with the bank's money. Let's use leverage. Let's use the bank money so we can make more money.
Yeah, that's right. I'm also a big proponent of that. I personally have an interest-only loan on my house. I don't even pay principal. So I would rather invest my money in the market. Now, disclaimer, if you're going to save money and not put it towards principal on your house, make sure you're putting it into an investment vehicle, not into your pocket or into your, spending shopping habits, right? So
Totally agree.
Yeah, you have to have the discipline set up, which I do, to take that differential in my mortgage payment of what I would normally be paying to interest. I actually got a rate in, I almost hate to admit it. It was 5 or 6 years ago, back when, rates were super low. I got a 10-year interest-only ARM, adjustable rate mortgage, at 3.1%. So I am not touching that thing. When it matures in 10 years, I'll figure out at that time what to do with it. But for right now, I'm interest only and just stocking my way in the market. Because the thought, Karina, is I can definitely earn more than 3% on my money in the stock market. So maybe just talk, if you could kind of just tell, we might have some not seasoned investors listening, and we might have some people that are really super good with their money, but just kind of in layman's ordinary terms, the difference between maybe over time, what average investments are, or what kind of people should look for to know whether they should prepay or not, or invest or whatever.
Yes, on average, the US market over the last 30 years has earned an 8% return on
Okay,
average. Of
8%.
course, we have outstanding years. We have years where the market makes less money, but
Sure,
on
up and down.
average, it's an 8%. So let's imagine, let's just put it in plain numbers. You have a mortgage at 3, 4, even 5%, and you can invest the money at 8%. Well, keep paying the 5, put your money to work at 8, and keep the difference.
So
That
that's
way,
a 3% difference. If you're paying 5 for the mortgage debt, but you're earning in the market 8 on average, well, that's a 3% gain.
exactly. And there are, or even if there's people that they don't like the market, and I understand it. I mean, there are other instruments where your principal can be protected of down years that in the market is not doing very well. So you can participate of the upside of the market and not participate on the downside of the market. When the market goes down, you simply stay flat. There are those instruments, or you can even invest the money in other type of real estate investments where you can be making between 5 and 10% fixed without any market volatility. So for me, it makes no sense to prepay the house if you have the liquidity. I'd rather invest it in some of these instruments that we can find the one that best suits your risk tolerance, and keep the difference, keep the spread.
So let's talk about a couple of ideas for people to think of before they start thinking about paying towards their mortgage, because there is a time and a place in it. I mean, I'm now over 50, so I'm kind of starting to think in a different way as far as, okay, when do I really don't want to have a big mortgage when I'm 60, right? So I'm starting to think a little differently. But let's just say someone who's under 50 still has a lot of savings years ahead of them. What are some instruments to think about, like checking off the list? Like, okay, do I have these other things fully funded before I think about paying off my mortgage? So the most obvious one is 401k. So maybe talk about that, and insurance and things like that, life insurance.
Yes. Well, the 401k, it's a very good instrument, especially if you are getting a match from the company that you work for. For sure, if you're getting a match, you need to put the minimum of your part to get the maximum matching from the company. If you are in a traditional 401k, but sometimes people have access to a Roth 401k. In that case, that money is after tax, but all the money is going to grow tax-free, and you're going to be able to withdraw it tax-free. In that case, I will maximize the contribution that you can do yearly, and it's around 20%, 20,000, I'm sorry, and 26,000 when you are above 50.
Yeah, so that's a lot of money that people could be working on before they pay off their mortgage. Because again, that money in your 401k or your SEP, if you're self-employed, or your Roth, it's growing with the market. So that 8%, I know it was a 30-year average, but still, it still applies, right? The law of averages, that you're leave that money in there and it's growing, which is going to benefit you more than sitting in your house where you can't even access it, right? In case of
yes.
Whatever.
And as I said, there are other instruments where you can participate of the upside on the market and not the downside, and they can still give you very good returns between 5%, 8%, 10, 13%. There's even, if you love real estate, you're thinking, I want to prepay my house because I want to own that piece of property because I love real estate investments. Well, I will say, take advantage of that excellent mortgage that Jen got you, and put that money to work in another piece of real estate. And that way you are taking advantage of the low interest rate. And there are investments in real estate, as I said, between short terms, between 6 months to 24 months, where you can be earning between 5 and 10% interest.
Yeah, so I do want to mention that because there's some people that own real estate where they'll go and buy 123 ABC Street, and they're the landlord and they charge somebody rent. Like, that's a traditional way to own real estate. But then there's what we call passive investing, where you can find a fund. And actually, if you want to reach Karina, what's a way to reach you if someone is listening and wanted to reach out? Just your website, or how would someone reach you?
Yes, they can go to our website, www.exfinia, that is EX, F as in Frank, I, N as in Nancy, IA.com. They can go there, or they can email us at info@exfinia.com. And yeah, we can answer all the questions.
So there's some passive. I know that you have some groups that you know here locally in Houston, or even not even local, that people can be passive investors, where you contribute a lump sum and then you're paid a dividend monthly. If you're like, oh, I don't want to deal with being a landlord, and I don't want to collect rent, and I don't want to have to fix the toilet and all that stuff, there's also passive investment opportunities. So connecting with a financial advisor. I'm not a big fan of day trading. My husband and I tried it at one point, and it did not go well. And it's, having an expert to help you, there's a total upside to that. But when she talks about real estate, I just want to clarify for those that might want a little more information, diversifying, not everything has to be in the stock market. So 401k and IRA, definitely max those things out. And then there's some things you can do in real estate. There's also I'm a big proponent of life insurance. My dad I guess I just grew up with it. He's sold life insurance since I was like 3 years old. So there's also, Karina, some life insurance policies, right? That, again, depending on the person, you have to talk to them and see what's right for them, where they could put money into a vehicle that later is not going to be taxed, right? It can grow tax-free as well. Is that right?
Exactly. Life insurance has a preferential tax treatment. And since all the premiums that you're paying are after tax money, that money will grow tax-free and you will be able to withdraw it tax-free. And now there are policies that they can do 3 jobs with one policy. They can give you, of course, protection in case of a premature death, but they also give you protection in case of a long-term illness, in case of a chronic, critical, or terminal illness.
Yeah.
That we know that we are living longer, and the probability that at some point we are affected by a long-term illness, well, that probability increases. So we need to have that protection so we can leave our savings and our retirement accounts alone and have that protection, that policy paid for those expenses without having to touch our retirement funds. But let's say nothing happens, we stay healthy, we are alive, all that money that we save there, we can withdraw it tax-free for whatever reason at whatever time. We can use that money to fund our retirement, to fund our kids' education, to start a new business, to grow our business, to buy a new property, or to travel around the world if that's what we want to do. So it's super flexible and it has tax advantages.
Yeah, there are really some good different policies and some good loophole tax. I hope the IRS is not listening, but there's some good tax, way to kind of evade some estate tax and things later on. Life insurance is a really good way to do that. So everyone's at a different level. But one thing I do want to mention, I don't want to talk too much about insurance because we're talking about all other things, but people think that, oh, long-term illness is just for old people. That is not true. I have heard and known people where they're 30 years old and something happens and they're in an accident. You can have a long-term disability in a moment's notice, it doesn't discriminate. No matter what age you are, there's something that can happen. So I personally am a really big proponent. So someone like Karina is going to definitely know the ins and outs of what's good for you. And it depends on your age and your family. And there's all kinds of questions to be asked. Am I right, Karina?
Yes, and what you mentioned about the IRS designed this code for life insurance because they want to incentivize us to be self-insured. They don't want us to all fall into the
They
arms
don't want
of
us
the
cashing in
government.
on Medicare. Yeah, no, that's true. There's a
Yeah.
method to the madness for sure.
Yes, so
For
they
sure.
design these tax advantage products so we can
Utilize them.
use them and take advantage of them. So
Yeah. So I think the point, just to wrap it up, is, and again, you can reach Karina at xfinia.com, right?
Yes.
Yeah, Xfinia, and we'll put it in the comments in the description. We'll be sure to put your website as well. So basically, there's several things that you can do to make sure that you and your family are covered, not only for retirement and earning more interest cumulatively than what you're paying on the mortgage, but also making sure that, I mean, we didn't even touch kids' education. There's some life insurance policies that can help with that, or a 529. I actually have a 529. Before I found out there was a better product, I'd already done it. But some people want to do the 529. So again, it's great to talk to someone like Karina, and you could call her on the side and ask her different instruments. That I just wanted to expand people's thinking of these types of products before they rush and say, oh my gosh, I'm going to prepay. And I'm not saying don't send an extra payment to your mortgage. A little goes a long way, but like maybe $50 or $100 a month can help shave off some interest. But that could also really benefit you as well, $50 or $100 a month. I mean, that's like a life insurance policy premium, right? So someone like
Yes.
Karina is going to help you sift through all of those things.
And another thing, I mean, what you're mentioning, yes, it's true. But on top of that, Jenny, when people have already accumulated a lot of equity in their home, they've been paying their mortgage for several years, they already have equity built in, they can even get a HELOC, a home equity line of credit, to pull that money out and invest it in real estate. I personally did that. I will personally not pull the equity of my home to invest it in the market, because to me that's a lot of risk. But if you pull the money out of real estate with a fixed cost, right now a HELOC could cost you around 5%. But if you can invest it at 8, 9, or 10% in real estate with a fixed return, you have fixed cost, fixed return. With a spread, you keep the difference and you're putting the equity of your house to work instead of being sitting there on that equity, without really growing much besides the appreciation. Because if we are not putting our equity to work, what is happening? The house is appreciating and we are paying higher taxes on the property taxes.
You bring a really good point. Thanks for bringing it up, because a home equity line of credit is like a second lien. It's like a little piggyback loan. It's just like a
line of
a little
credit
add-on. It's like a menu. It's like a dessert that's added on to so you got your regular mortgage, and then you've got either the HELOC or, we do home equity loans where we wrap your big mortgage in with it, and that's where you can really fix the cost. The HELOC actually has a variable rate, so there's pluses and minuses to it, that you could just reach out to me and talk to me about. But the spirit of it is, especially in the last couple of years, houses all over the country have appreciated at ginormous rates. Now things are calming down. They're not going to go backwards, but they're calming down. And I would say that there's some people sitting on some equity that they didn't think about that they could take out. Take out the equity of their home. Now in Texas, you can only take out up to 80% of your value, which I think is great. Texas has a lot of protections for homeowners. Other states allow you to take up to 100%, which is really, really risky, but you can take out up to 80%. And like Karina mentioned, use that money and you can You could make improvements to your house. You could add a pool. You could invest it. I mean, making improvements to your house also increases the value for you to sell it later on. So there's many things that you can do to leverage your real estate as well, that people might, just to expand your thinking, that you might not be thinking about. So Karina, before we wrap up, is there anything that we've left on the table as to maybe the benefits of why to put less money down, or why to think about leveraging some equity in your house?
Well, it's just to make the numbers. I will say a lot of people are adverse against leverage and debt. But once I show them the numbers of how much in the long term they can have just by putting their money to work, then it clicks and then it makes sense. So allow yourself to go over the analysis, look at the numbers. Math doesn't lie. Hard numbers are hard
Math
numbers.
does not lie. I do like that. It does not. And you are definitely a numbers person. Ever since I met you, God, you have just been crunching the numbers. So for those listening, Karina you're a penny pincher in the right way. Like, she's super careful with her costs. So for her to be saying leverage and keep debt on your mortgage, it's a pretty big compliment to the industry, because if there's savings to be had, she's going to have it. And so it's a smart decision. I mean, and you're right, the numbers and just getting with an appropriate person to really go through those numbers with you to see what's best for you and your family. So when I do mortgage, when clients are telling me, oh, I want to put 20% down, I'm like, hey, are you open to looking at 5 or 10% down and just thinking about what you could do with that money? I don't give them financial advice, but I just kind of open their eyes to talking to someone like you, or saving that money. A lot of people are buying homes that need to be repaired. So it's like, hey, put less down and put that pool in to increase the value, or max out your Roth, or put it in a 529 for your kids, put it away all in one big lump sum, and then you don't have to worry about it. Right. So there's lots of cool things that you can do, which is really kind of the point of this podcast episode. Well, Karina, thank you so much. Karina Gutierrez, Xfinia Financial. I appreciate you giving us your wisdom today on this podcast. And I think I'm on your podcast next week, right? What is your podcast handle? What's your site?
Oh, our podcast is called Universo Financiero, which is in Spanish. So for our Spanish listeners, Universo Financiero, and we talk about all different type of financial topics. So Jen will be talking to us next week.
Oh, good. So I'll have to speak Spanish, right? Which is fine. Okay. Yes. I am bilingual, by the way, so thank God. But I do have my little gringa accent. But okay, I'll be speaking Spanish next week. Universo Financiero.
Yes.
Very good. Well, thanks for joining us today. I super appreciate it. And we'll talk to you soon.
Thank you for the invitation.
Okay, Karina. Thanks.
Bye-bye.